Okay, welcome back to capitalforextraining.com. So this is the second video of our two-part series on how to trade the triangle and the wedge. So if you're new to trading and you haven't watched the first video, which is where we go through how to define these patterns, please do so. And then just come back here, because in this video all we discuss is how to trade this pattern. But before that, you really need to know how to define it first. So, okay, moving on. Before we go into how to trade it, what I need you to do is load up an indicator on this chart, and that will be Bollinger Bands. What I need you to do is actually load up 3 sets of Bollinger Bands, and in terms of setting, every single one of the 3 Bollinger Bands has to have a period number of 20. That won't change. That will be the same in every single one. The only thing that will change is the deviation in every one of those Bollinger Band settings. So the first one, deviation, is 1. Then the second one, which is the next in the one in the middle, needs to be 1.5 in the deviation. Period stays at 20. Just change the color as well so that you can differentiate. And the last one, which is the most extreme one, period stays at 20, but the deviation has to be 2. And again, change the color so you know which one's which. Okay. The period 20 is just this simple moving average in the middle, which is the 20 period moving average, and obviously that won't change because it's the same in all 3 Bollinger Band settings. The only obviously things that will change the deviation, so you got number 1 here, which is green in deviations, 1.5 in deviations, which is the orange one in the center, and then you've got the most extreme one, which has a deviation of 2, and obviously that will be mirrored on the other side as well. Now, the reason why we use Bollinger Bands in this pattern when trading wedges and triangles is because we only start shaping these patterns once they start bouncing off Bollinger Bands themselves. Okay, so as you can see here, what I've got is a bounce off the Bollinger Bands here, and I can now start joining up that upward sloping trend line. Okay. And in turn, all I'm doing at this stage is waiting to see what kind of pattern will be created here. And I can see that this is a standard triangle that's being created, which, if you remember, is the bottom left one here, okay, which is the integrated version of the ascending triangle and the descending triangle. Now, if this was a wedge, i.e., one of these on the right hand side at the bottom, will still trade the same. Everything is exactly the same. It's just how the lines are. The only difference is obviously where the lines are pointing. So I'm just going to zoom in a little bit for you here. Now I should really say the reason why we use those 3 settings in Bollinger Bands is so that we don't miss out on any smaller patterns being made. So for example, if you had just deviation setting of 2 and this pattern occurred, you know, somewhere, let's say here, then you wouldn't be able to trade that because you still haven't had a bounce off the 2 period deviation. However, so that's why we put the other 2 in, which is 1.5 and 1, so that we give ourselves the best chance in defining and recognizing smaller wedges and smaller triangles in our charts. Okay, so that's the only reason why we use them. But we use the Bollinger Bands in exactly the same way. It doesn't matter what deviation setting they have. So once we've got a bounce off the Bollinger Band, we can see here that we've tried to break out once, failed, then go back down, and then try to break out once again, failed, bounced off, and then we finally broke out. Okay, now if you remember, what we're looking for is a close above that trend line, okay, above that descending trend line. Now you could probably argue that if you zoom in a lot more, there could be a little close above that trend line, but to be honest with you, I'll be very nervous in doing that. So what I would do is wait for the close that's much more clearer, which in this situation is this one here. However, if my target is the difference between the last hit on the bottom line and the point of penetration, I'm already out, so I'm not going to be able to trade that pattern. Okay, now that doesn't mean that you can't trade this pattern, because this is when you need to use multiple time frames in order to get into that trade as early as possible. You know that the line's been penetrated, okay, and it hasn't closed. Let's just say that this has not closed above that trend line, and in order for you to place the trade in an upwards direction, you need the close. The only thing you need to do is go into the hourly chart, okay, which is H1, and see whether that's closed in the hourly charts, and you can see that it has. Okay, So in fact, I'm not going to put a line because I'm going to check some more time frames. So it's closed in the hourly chart. If you go into the 30-minute chart, you can see that it's closed there as well. Further on, if you go into the 15-minute chart, yes, it's closed. Okay, and in the 5-minute chart, it will close because obviously the 5-minute chart is much lower. But if you're trading H4, then the only thing you need to do in order to get into these trades is have a look at whether the closes occurred in H1 and 30-minute time frame. If you're trading this in an hourly time frame, i.e. H1, then what you'll need to do is check the 30-minute time frame, the 15 and the 5, okay? And just make sure, in fact, you can probably, the 5 is just for a bit of peace of mind, but most importantly, it's the M30, M15. So just go back 2 time frames and make sure that this is closed above that trend line in 2 of the lower time frames. If it hasn't, then just wait. And wait till it closes, and eventually it will close and you'll be able to get into the trade a lot earlier than you think. So back to our original chart. So we know we've got to close in H1 in this area here. In fact, I'm just going to mark it up so that you can see where we would have entered. So we would have entered there. Okay, and in fact that's probably a little bit too long. 1 second, I'm just going to delete that. I'm going to use that. So we would have entered the trade round about there. Okay, we go to H4, and look how close that is. That is literally slightly above that trend line. Okay, and then obviously what we do is measure a target. So we go just a little bit below this ascending trend line, so we're not greedy. A little bit above our other lines, so we've got 370 pips. I don't move my cursor, I just drag it up in a different direction. Oops, sorry, what was that? 376 and 376, which is 131,544, and that's our target. Okay, and your stop loss simply has to go just a few pips below this trend line here. Okay, I'm struggling with these little lines, but there you go. Okay, so your stop loss is here, just a few pips below the last hit. You measure your target, as we mentioned in the first video, in between these two, in between the last hit and the penetration. You look for a close in the lower time frames, and as soon as you have that close, you measure your target, and which in this case is 544. And you can see how quickly that went up in that direction. So remember, when you look, that is literally it. That's how you trade the wedge, that's how you trade the triangle, the ascending triangle. They're all literally the same, except they just come in different shapes and sizes. So remember, you only start drawing your lines on different sides once you get a bounce on one of the Bollinger Bands. And from that point on, like we said, you look for a penetration of the pattern. Check in the 2 lower time frames whether the candles have closed over the lines, and after that point you simply measure your target. Okay, we'll see you for the next video.